Consumer confidence remains weak. Let's have a look. Hello everyone, I'm Florian Heise, and welcome to another episode of HeiseSays. I've got my stein of coffee, and I thought we'd have a look at the latest update from Westpac regarding consumer sentiment. Now, I will bring up the chart here, and you can see that consumer sentiment has ticked up slightly from the last time we looked at it, but it's still below 100. And the fact that it's below 100 means that there are more pessimistic, grumpy bastards like me out there than there are positive, upbeat, ponytail wearing gym girls, jumping up and down. Just do one more exercise. So let's have a look at this, guys. Consumer sentiment remains weak despite a lift. The Westpac Melbourne Institute's index of consumer sentiment rose 2.3% to 95.5 in February, up from 93.4 in January. Despite the modest improvement this month, the sentiment remains weak overall. At 95.5, the index remains well below the long-run average of 101.4 and firmly in pessimistic territory. Readings below 100 indicate that pessimists outnumber optimists. This downbeat mood has prevailed since mid-2019 and coincided with a market slowdown in consumer demand that looks to have carried into early 2020. I think, now this is the February data, do you think this is going to pick up some of the scares from the coronavirus and maybe some resource drops and construction industry supply issues? Perhaps. We'll have to see building approvals next month and the unemployment as it comes through. The lift in sentiment this month likely reflects easing concerns around bushfires and comes despite some significant negative developments, most notably the coronavirus outbreak abroad. On the positive side, the survey week saw extensive rain in bushfire-affected regions, with several large fires declared contained. And that is, well, that's fantastic news. I know I've got rain right here. Our car is literally bogged in the front lawn, the Kia Carnival. I'm probably gonna have to get the damn thing towed out of it or jack it up and put some stones under it. I'm waiting for the rain to stop before I'm doing that. We're just not driving in that car. The week also saw a confident tone from the RBA, with a range of commentary emphasising the bank's positive medium-term outlook for the Australian economy. Notable consumer sentiment readings show a clear improvement over the course of the survey week. Why? I don't understand. We're a primitive economy. A large portion is based on exporting natural resources which have declined in value. We've got a huge tourism sector and an international student sector which is going to take a hit because of the bushfires and the virus. Construction approvals, building approvals have slightly ticked up but are still lower levels. And now we're hearing about building projects being delayed because of lack of materials. Why are they making a positive prediction for the future? Can someone tell me in the comments why? Do they have that much confidence in CoreLogic's ability to push up the housing prices? Anyway, against this, the escalating coronavirus outbreaks looks to have only a limited effect on consumer sentiment. While surprising, this is similar to the experience during the SARS outbreak in 2003, which had little or no impact on sentiment in Australia, although it had a material impact on confidence elsewhere, China in particular. The fairly muted response from financial markets may also have dampened the sentiment impact locally. The ASX is down only negative 0.6 since the previous survey in January. That said, the full impact of the outbreak is yet to be felt locally, and we may see more of a drag on sentiment in the months ahead, particularly as the hit to sectors such as tourism and education start to come through. Well, yes, we're waiting to see that impact on the economy, aren't we? The component detail this month shows the gain came from a recovery in expectations for the economy and in attitudes towards major purchases, particularly offset by a deterioration in assessment of family finances. The economy next 12 months sub-index rose 5.4% in February, and the economy next 5 years sub-index rose 4.3%. Both sub-indexes partially reversing the sharp falls seen over the previous 2 months, but still 1 to 2% below the November levels. So assessments of family finances were less promising. The family finances versus a year ago sub-index fell 1% in February to be back near recent lows, while the finances next 12 months sub-index was essentially unchanged in the month, but down sharply since mid-2019. Negative 10.7% compared to the average read over the first half of 2019. Both sub-indexes remain well below their long-run averages, despite several interest rate cuts, significant tax relief, and a turnaround in the housing market. Have we seen a turnaround in the housing market? That's going to change. These claims of a turnaround in the housing market is going to be impacted if we have delayed ability to import products. Some of these houses have 90% of their products manufactured in China, guys. So, a pattern that points to other powerful headwinds bearing down on household finances. So we can see it here. Responses to an additional question on interest rate expectations showed fewer customers expect more rate cuts in 2020. Every 6 months, we asked consumers about their expectations for mortgage interest rates over the next year. The February results show just 16% expects rates to move lower, down from 22% back in August, but still above the 10% read a year ago. Perhaps the most telling statistic is that 13% of consumers report that they simply don't know, well above the 7% average seen over the last decade. Attitudes towards major purchases improved in February, but still look to be restrained. The time to buy a major household item sub-index rose 2.7% in the month, but remains 1.3% below its November level. At 116.4, the sub-index is well below its long-run average of 127. Boy, we're optimistic buyers, aren't we? Australians are optimistic buyers, suggesting consumers will continue to keep a tight rein on discretionary spending. And that will flow into the retail sector and the continued decline in business activity there, the growth of the retail recession. Someone left a comment asking, is this really retail recession or just shifting taste, increased rents and business shutting down? And I'm responding, well, that is exactly what a recession is. A sector which is recessing. If people are moving from the bricks and mortar retail, purchasing online, which we are not seeing, it's not that significant. But if they're cutting back on their discretionary spending and a sector of the economy recesses, that's a recession, guys. I firmly believe there's certain parts of our economy that are already experiencing a recession. It's not equal. And I think that's why we're seeing different parts of our civilization. Well, here's a question for you. Is Australia more stratified with regards to haves and have-nots, or wealthy and unwealthy, or exposure to economic troubles than we have been in the past? Is Australia changing from a merit-based civilization, which is pretty much roughly flat social hierarchy, to a more established social hierarchy? We'll have to see. Maybe Australia won't be as egalitarian as it pretended to be. Labour market concerns have shown little change. The Westpac Melbourne Institute's Unemployment Expectations Index rose slightly, edging up 0.6% to 134.7 in February. Recall that high readings indicate more consumers expect unemployment to rise in the year ahead. So we definitely are a pessimistic bunch when it comes to unemployment. The index has moved sideways in recent months, but still is up 12.3% on this time last year, consistent with a slowdown in jobs growth and rising unemployment over the year ahead. Housing-related sentiment was mixed in February, buyer sentiment deteriorating, but price expectations up a touch after recording another very strong gain last month. The time to buy dwelling index fell 5.6% in February, unwinding a similar size gain last month to be back near recent lows. The monthly pullback was broadly based, suggesting it may reflect some shift in expectations around interest rates. At 112.1, the index is again showing a clear softening compared to last year's peak around 127, although it remains well above 2017 lows, which saw the national index touch 90. So the Westpac Melbourne Institute Index of House Price Expectations Index edged 0.2% higher in February, consolidating after a spectacular 70% surge over the previous 9 months. So the media is working. People are expecting housing to go up. And if people expect it, isn't that half the battle? If the masses think it's just going to go up, it's going to go up. Will it be able to crash? Will people just refuse to sell? Will we have the low volume that we're seeing? Until the external factor, maybe a sharp decline in certain parts of the economy, increases maybe the arrears rate, drives up unemployment rate, and people are forced to sell. Consumer price expectations continue to lift in New South Wales, Victoria, cooled in Queensland, and partially retraced last month's very sharp gain in Western Australia. Wow. WA is down 12.9%. The Reserve Bank Board meets on March the 3rd. Westpac expects the bank will again leave interest rates unchanged, but retain a clear easing bias. Do you think so? We'll have to see if we get an impact in unemployment. Maybe it'll take a bit of time for these external factors to actually be felt at a level here in Australia. So, we continue to have a more downbeat view on Australia's economic prospects for 2020, with growth expected to be around 2% rather than RBA's expectations of around trend of 2.75. Why? We have been below trend on a per capita GDP basis since the GFC. We've spent more years below trend than above. We've been below trend. This is the thing with all these numbers. They may still sound good, but when you realize we're getting a population growth, it isn't as good. As such, we see a combination of weak economic growth and deteriorating labour market conditions drawing a further policy response from the bank. However, the RBA's surprisingly confident forecast, yes, because the RBA are always accurate. You know what? Today I'm going to turn this into a mug. You'll see it. I'll definitely turn this into a mug. However, the RBA's surprisingly confident forecast, as well as the near-term volatility associated with temporary shocks, cast doubt over how quickly they will respond. Currently, we have April penciled in for the next cut, but the governor may need more time to be convinced. So there we have it. Let's have a look at the numbers here. Consumer sentiment on year-on-year down. Family finance down. Everything's down. Everything's down on a year-on-year. Month, slightly up. But this year one, this is what we need to look at. So there we have it, guys. Consumer sentiment has edged slightly up. So we'll have to see where it goes. Thank you for watching. Please like, share, and subscribe to the channel. If you're a super fan and want to help us that bit extra, there are a few ways you can. You can simply share the content, share it on Twitter, social media, LinkedIn, get the word out. We also have a few other ways you can support us. You can join us on Patreon, making a monthly donation. You can join the channel here on YouTube and get access to badges and emojis. We also have affiliate links with Amazon, eBay, and Independent Reserve. If you make a consumer purchase, we receive an advertiser's fee. It costs you nothing. I notice some people have been going and buying a whole lot of 4K Blu-rays. The advantage of that is, well, they can't edit those and re-upload them, can they? Like they've been doing with all the other videos. And we have PayPal and our very own merch from the HeiseSays website. Thanks to everyone who's supporting the channel. Have a great day, and I will talk to you all later. Bye for now.